And I'm thrilled to be here with you today for this presentation. Today, we're going to be talking a little bit more about modeling multiple tax strategies within RightCapital. So this is actually a new feature that was released, I believe, a bit earlier last week. And this is something that allows us to model some new scenarios using the tax strategies module in RightCapital. So using this feature, we can now create and save multiple tax strategies. And what that allows us to do is either directly compare two different tax strategies in the retirement analysis, or to model specific tax strategies and apply them to specific proposed plans in RightCapital. So while it was possible before to model tax strategies and integrate those into your proposed plans, we now have the ability and the flexibility to model multiple strategies and mix and match those depending on our needs and the needs of our clients. So I'm really excited to dive into this here today. Let's just take a quick look at our agenda before we switch over to RightCapital here. For those of us joining today that might be a bit newer to RightCapital in general, I do want to start things off with a quick review of the tax strategies module. So we will walk through the different strategies that are able to be modeled there and take a quick look at some of the key visuals and other charts and information available within that tool. We'll then dive a little more specifically into modeling multiple tax strategies within the context of a case study that I've put together for today. We'll then apply some of those tax strategies within the retirement analysis module and take a look at some of the new situations that we're able to model there. And of course, throughout the presentation, we'll be touching on some key comparison visuals that you may find yourself leaning on in regards to tax strategies with clients. That being said, allow me to switch my screen over to my RightCapital login here. As I'm doing this, I do want to remind everyone, firstly, that these webinars are recorded, so we will be posting the recording of this webinar in our Help Center shortly after the presentation ends here today. Secondly, there will be a live Q&A at the end of the presentation as well. So while I do have plenty of prepared content for you today, ultimately, I want to hear from you. So feel free to write in. You should find a Q&A fields in the Zoom control panel on your screen. Like I said, don't hesitate to write in with any questions you might have, and I'll be sticking around after the fact to answer as many of those questions as I can. All right, so here we are in my advisor portal. Let's dive in here today. We are going to start by taking a quick look over our case study. So let's dive into this plan here for Jesse and Leslie. And in particular, I want to kick things off by taking a look at the blueprint module, just to get us all acquainted with these clients and their situation. So in the profile blueprint tab here, we can see that these clients are currently in their early 50s. And just taking a quick glance at their net worth and all of their assets and liabilities here, we can see that these clients have put together a pretty solid nest egg here. These are clients that have clearly been saving for a good amount of time, and you have quite a significant amount of, especially tax-deferred assets to work with within this plan here. So, full disclosure for the purposes of our presentation here today, I have set up this plan somewhat intentionally to have quite a bit of tax-deferred assets. So, it might be a bit exaggerated, but I'd argue that it's also somewhat rooted in reality as well. A lot of folks, even those that might be good savers, do sometimes end up in a situation like this where, a significant chunk of their retirement savings is in tax deferred accounts like 401ks and IRAs. And although the dollar amounts might look good on paper, they may not be aware that they could end up in a higher tax bracket potentially in retirement with some pretty significant RMDs later in life. Or, maybe they are aware, and maybe that's one of the reasons why they're coming to see you in the first place. So that's what we're working with here in this plan. In addition to the blueprint, another great visual you may want to reference to kick off these kinds of conversations with clients is the tax allocation chart, which you can find in the investment module. So if we take a look here, we start to get a sense of how these clients' assets are divvied up between the different tax buckets here. And this can be a great way, like I said, to maybe kick off some of these conversations and really show clients, you know, with what you have today, 73, 74% of that is tax deferred at the moment. We can even see the dollar amounts on the right here and zoom in on those specific accounts within each bucket if we'd like. So this can be a helpful aid for those conversations as well. I do want to dive next into the tax module, in particular, before taking a look at the tax strategies tool, which is going to be our main focus today. The tax estimate can also be helpful just in terms of some visuals that might be beneficial for you and your clients in understanding their future tax projections. So, speaking of that future tax picture, the effective tax rate chart can always be helpful in terms of showing clients their federal, state, and FICA taxes over time. But also, for our purposes today, the federal income tax bracket chart highlights their marginal tax rate over the course of the plan. So I mentioned before, some folks may not be aware that with those tax deferred assets in retirement, they might bump up into a higher tax bracket potentially once they have to start taking RMDs in the later years of the plan. We can actually see that this particular plan is a good example of that. They're sitting in that 22% bracket during their working years, and once they start withdrawing RMDs, they're actually bumping up into the 24% bracket after that point in time. So, these candidates might be a good, or rather, these clients might be good candidates for some of the strategies that we're going to look at here within the tax strategies module. So I always like to touch on some of those key visuals before diving into actually modeling some of these strategies here. But now that we've set the stage, the next thing that I want to do is take a deeper dive into the tax strategies module in particular. So the tax strategies module, this is a module that released last year. Some new features here in addition to some returning tabs that are RightCapital classics. So again, for those of you that are a bit newer, I do want to take a quick moment, firstly, to walk through some of the different strategies that are able to be modeled in this area using the action items at the bottom of the page, and also to showcase some of the other visuals and features that you can find within this module. So first things first, in terms of tax strategies, we have the ability to model three specific kinds of strategies here. The first of those is listed right at the top here, which is the asset location strategy. It's sometimes called an equity allocation strategy as well. And for those of you that might not be familiar, the idea here is that we're pairing assets with specific types of accounts for maximum tax efficiency. More specifically, we're pairing tax inefficient investments with tax advantaged accounts and vice versa. So, typically what that looks like is shifting as much equity as possible into either the taxable or tax-free account buckets, and then reserving our tax-deferred accounts as much as possible for those bonds and fixed income asset classes that are going to be taxed at slightly higher rates, most likely. So, this is a strategy that tends to be beneficial for clients that are in higher tax brackets, but that's very plan dependent, and it can certainly be beneficial for anyone potentially. There is actually a specific chart in this area that does help to visually demonstrate what's happening with this strategy a little bit more clearly. So I always like to highlight the asset location chart here in the summary tab. So let's actually reset this to pro rata just to start things off. By default in RightCapital, we actually spread out a client's equities evenly between the three tax buckets here. So if you select pro rata on the left-hand side here, this is actually what's happening by default in RightCapital. And you may notice the taxable bucket having slightly more fixed income. That's a result of the client's bank accounts also being included in this bucket. But in terms of their investments, we're divvying up the equity and fixed income evenly across these three buckets. However, if we switch back to one of these other strategies that we were using a moment ago, we can see a change here. We see we're intentionally front loading that tax-free and taxable bucket with as much equity as possible. And we're overflowing a little bit into the tax-deferred bucket, but we're mostly reserving this for fixed income classes as much as we possibly can. So that's the general idea here with this strategy, and it does tend to yield some benefit for those clients, especially in higher tax brackets, like I mentioned. Our second strategy that we can model here, in addition to asset location, is asset withdrawal, sometimes called the withdrawal sequence. And this is something that is situationally useful, especially if clients might be spending more than they're earning during their plan. And what this strategy allows us to do is pick and choose which account buckets we want to draw from first whenever a client spends more than they earn in a given year. So we sometimes call those negative net flows in RightCapital. And if we take a quick look at the cash flows tab in the retirement module, I'll be able to explain that a little bit more clearly. So if we take a quick look at the cash flows, specifically the summary table here, what we mean by negative net flows is in the cash flow summary, if a client's cash inflows are outweighed by their cash outflows, so if they're spending more than they're earning in 1 or more years, you'll see a negative number in parentheses here in the right-hand column under net flows. And that's indicating that those clients are spending more than they're earning, and we are going to have to dip into their investments to fund that cash flow shortfall in that year. So when that happens, that's where we can fall back on our withdrawal strategy. Which account buckets do we want to pull from first to fund those cash flow deficits during those years where we have a shortfall? So by default in RightCapital, we'll pull from the taxable bucket first, followed by tax deferred, and lastly tax free. But you can choose, depending on what assets you want to draw from first or what assets you want to reserve and allow to grow as much as possible, you can select a different order of operations here. And again, in the cash flows, specifically in the accounts tab here, we can actually see a bit more clearly the withdrawals occurring from those different buckets. So in this example, we are withdrawing from that taxable bucket first, and we can see for the most part, our taxable bucket is able to cover the majority of our negative net flows throughout this plan. So you can certainly play around with these different strategies and see what might yield the most benefit for clients in the long term. Our last strategy is probably the most popular strategy that's modeled in this module, which is the Roth conversion strategy. And for modeling Roth conversions, I do actually like to switch over to the calibration tab for this, just because these visuals within this tab tend to coincide a little bit more with the Roth conversion strategy in particular. So what this allows us to do is model Roth conversions up to specific tax brackets. So in this case, I actually have some Roth conversions already happening here. I've selected the ordinary income tax brackets as our conversion target. So, there's an ordinary income tax bracket chart to go along with that so we can actually see where the client's adjusted taxable income falls in relation to those ordinary income tax brackets over time. We can also see in this particular plan, if we remove the conversions for a moment, that this is a good example of that sort of classic U shape in between retirement and RMDH, where their taxable income drops off as a result of them retiring at age 65 and then ramps back up once they start taking RMDs at 75. So again, these clients are potentially a good candidate for Roth conversions. At the moment, I'm converting up to that 12% uh, ordinary income tax bracket. So we can see in any years where the clients are below that bracket in terms of their taxable income, we are making Roth conversions right up to that upper threshold for that bracket. So we're converting as much as possible without bumping them up into that next bracket, by exceeding that threshold. So that's the general idea here. You don't necessarily have to target ordinary income tax brackets. You can also choose to target capital gains tax brackets if you'd like, or Medicare premium tax brackets, which is going to allow you to convert right up to the point where their Medicare premiums would increase due to IRMA. So if that's something clients are concerned about, you can target that threshold as well. And there is a chart for each of those targets depending on what you're looking to convert up to. So there's a chart for each tax bracket threshold. I also want to mention that in addition to the bracket thresholds, you can also control the timing here if you'd like. So at the moment, we're converting throughout the duration of the plan. So we actually see towards the end of the plan, we are making some conversions in those final 2 years here. So maybe we don't necessarily want that to happen. We do have the ability to control the timing as well. So if we scroll down to the bottom here, let me reset this for the moment, back to 12%. If we click the Edit button in the lower right, we will open a drawer on the right-hand side of the screen, which will allow us to specify when these conversions start and when the conversions end. So just for the sake of example, maybe we do want those conversions to start as soon as those clients drop below that bracket threshold, but maybe we want those to end when the clients hit RMDH. So let's choose to stop those at 75 and click refresh here. So with that change, we still have those conversions happening early on, but we no longer have those conversions in the final 2 years like we did before. So you can be a little more specific with the timing of the conversions as well as the amount using that feature. So those are the three strategies that are able to be modeled here. Once you've modeled one or more of these strategies using the action items, we have plenty of charts and comparison visuals in this module to showcase the value of those strategies in different ways. So we already touched on the summary and calibration charts, but the comparison tab also has some great charts to showcase some of that value. So we can directly compare ending assets, or rather invested assets over the course of the plan. We can take a look at federal taxes paid over time and show clients some of the timing trade-offs related to Roth conversions, potentially, paying a bit more early on and a bit less once they hit RMD age. There's other charts here that compare RMDs, withdrawals, account balances, tax-adjusted ending assets. So we're not going to touch on every single chart just for the sake of time here today, but there's plenty to look at that will, compare and contrast different elements of the plan. I also want to quickly mention the fact that the details tab is where you can dig into the cash flow tables a bit more for your tax strategies. So if you're looking for a more granular breakdown of the conversions taking place and you want to see the specific dollar amounts, you'll find that here. We can zero in a little more specifically on the taxes paid over time and so on. So definitely value to these cash flow tables. And we do also have a strategies tab, which has a solve for top strategies button for you. So if you're working with a new client or a prospect, and maybe you aren't quite sure where to start in terms of which of these strategies might be most beneficial for clients, this can be a helpful starting point. This is going to automatically calculate the top 5 strategies with the largest ending portfolio value. So if we give this a moment to crunch all the numbers, we'll see in just a second here what combination of these tax strategies, like I said, is going to yield the maximum benefit in terms of tax-adjusted ending assets. So this can be a helpful jumping off point if you're looking to get started somewhere modeling some of these tax strategies. All right, so that's a quick overview of our tax strategies module. The final piece of the puzzle here when it comes to modeling some of these tax strategies is that once you've modeled these strategies here, we can not only, showcase the value of these strategies in terms of ending assets, taxes paid, and withdrawals, we can also turn these on within the retirement analysis area for a proposal. And this is where our recent product update comes into play. So let's say we want to take these Roth conversions and this, asset location strategy that we've modeled here and turn these on within the proposed plan in the retirement analysis. Let's click into the retirement analysis module here. Within the action items at the bottom of this tool, so if we scroll down a bit and then open up our action items, you'll find a tax strategy item on the right-hand side here. We can choose to switch over from our current strategy to the proposed strategy and then click refresh in the lower right. That's going to take those Roth conversions, take that asset location strategy, and factor those into our proposed plan. So we see an increase in that case in the ending portfolio value as a result of those strategies. So that capability, already existed within RightCapital. However, you may have noticed that it's not just the proposed strategy that I can choose to implement here. I also have a couple of other strategies to choose from in this menu. And these are additional strategies that I've created and saved within the tax strategies module that I can toggle between and select for either this proposal or any others that I might be working on. So this is what we're going to spend the rest of today's presentation exploring. So first things first, how do we create these additional tax strategies? Let's bounce back into the tax strategies module and we can take a quick look at that process. So to create those additional tax strategies, we'll again want to scroll down to the bottom of our action items and click the edit button in the lower right. If you're at all familiar with creating additional proposed plans in the retirement analysis area, you'll actually find that this is quite a similar process. At the bottom of this drawer, you'll find a new Edit Strategies menu towards the bottom. And we have our original proposed strategy, of course, but we also have the ability to add new strategies by clicking Add Strategy at the bottom here. And whenever we add new strategies, we can name and save these, whatever we want to name those. And once these are saved, on the left-hand side of the action items, we can choose which strategy we want to work on using some of these options. So again, similar to the retirement analysis, whichever strategy is selected on the left is the one that we're currently editing using some of these action items, and we can dial in separate strategies to model whatever we want to see, and then we'll have the ability to implement those back within the retirement analysis area. So this allows us to do a few new things that we couldn't do before. We can design and implement different tax strategies for different proposed plans, and we can now also directly compare two different sets of tax strategies within the retirement analysis, within the context of that Monte Carlo simulation. And both of these things can potentially provide a lot of value depending on the situation. So let's start with that first example here. Let's pivot back into the retirement section. Maybe we're working with these clients and there's a specific what if scenario that we're modeling in addition to the original proposed plan. So as a reminder, for those of you that might be new, you can always add new proposals here by clicking add or remove plans on the right-hand side. In this case, I've already modeled a separate proposal here in which these clients are considering moving to Florida after retirement. And if we select that on the left-hand side, we'll be able to take a quick look. All I've really done here is add a primary home relocation, which sees these clients moving into a Florida condo that they already own in the year that they both retire. So, pretty simple setup here, but this could really be any what if scenario. Maybe we have these clients retiring a little bit earlier. Maybe we've modeled some sort of partial retirement scenario, or maybe we've shifted the client's asset allocation. And these changes could be changing the client's future cash flows and future tax projections quite significantly, to the point where maybe the tax strategies that we've dialed in for the original proposed plan are no longer such a good fit for this new what if scenario. So if we take that original proposed strategy that we modeled and implement that here within the context of our move to Florida plan, we actually see a small decrease in ending assets rather than an increase. So what we can do here is actually create a new tax strategy proposal designed specifically for this what if scenario where these clients are relocating to Florida. So let's do that. Let's click back into tax strategies here and just refresh this page quickly. The first thing that we'll want to do here is create that new strategy. So in the action items, I'm going to scroll back down to the bottom. I'm going to click the edit drawer in the lower right. Let me delete this other one I added here and start fresh here. So let's delete that new strategy. Again, to create a new plan, we'll click add strategy. We can name these whatever we'd like. So in this case, just to keep things simple, we'll call it move to Florida. Click the blue check mark to save the name, and then click save. Once again, we'll be able to select that strategy on the left-hand side, and we'll then be able to dial in a specific set of strategies for this specific proposal. There is one other step here that I want to make sure I highlight. When it comes to dialing in some of these strategies, something like Roth conversions maybe, you will also want to make sure to select that specific what if scenario in the upper right-hand corner. And the reason you want to do that is that's going to update the client's adjusted taxable income to make sure that all the strategies that we're dialing in are using the specific cash flow projections for this particular plan. So if you are creating a tax strategy proposal for a specific what if scenario like this, just remember to toggle to that specific scenario in the upper right. So at this point, if you had an idea of what you wanted to dial in terms of these tax strategies, you could certainly do so now. But this might also be a good opportunity to use that solve it button I mentioned before. So let's maybe solve for the top tax strategies for this move to Florida plan that will maximize ending assets for this scenario. And once this crunches the numbers and spits out some values for us, we can then replicate those options in our action items. So in this particular case, it looks like in terms of asset location, the tax-free first strategy is going to be the most beneficial. In terms of withdrawal strategy, looks like we're sticking with the default here. And in terms of conversions, looks like converting up to the 0% capital gains tax bracket is what this particular strategy is suggesting. So let's click refresh here, implement those strategies, and we can actually see back in our summary tab for that move to Florida scenario, this new set of strategies is again yielding some additional benefits, whereas the other set of strategies was not. So that's the idea here. Once we have this new set of strategies created and saved, again, we can switch back to the retirement analysis. Let me refresh this page. We already have our move to Florida plan selected on the left-hand side, and we'll now find within the tax strategy menu that specific set of tax strategies for this specific proposed plan. So we can click refresh in the lower right, implement that into our proposal, and make sure that the tax strategies that we're modeling here are the best possible fit for this specific set of variables being used by this scenario. So that's one way that we can utilize this new feature by designing and implementing multiple tax strategy proposals to coincide with multiple specific what-if scenarios and proposed plans. We can make sure that those strategies are a good fit. And if we toggle back over to the proposed plan here, we'll actually see that this one is still using the original proposed strategy that we chose before. So this plan is unchanged. So we can use our proposed strategy for our proposed plan and our move to Florida strategy for our move to Florida plan. The other way that we can use this feature, and the last thing that I want to explore here today before transitioning into the Q&A, is directly comparing two different sets of tax strategies. So let's say maybe we want to model Roth conversions for these clients, and we know that they're a good fit for conversions, but maybe we aren't quite sure, what that sweet spot is in terms of how much to convert. So maybe we want to set up a scenario here where, we're creating two different tax strategy proposals with different conversion amounts. And then maybe we want to compare those side by side so we can see the impact of those tax trade-offs on a client's probability of success. So to model a scenario like this, we can click back into the tax strategies module, and we can set up specific tax strategy proposals with different conversion amounts. Just to showcase one of our other key visuals here, let's say that maybe this is something these clients are considering not necessarily to maximize their own assets during their lifetime, but to maximize assets for their children or heirs upon inheriting their portfolio after they pass away. There's a great chart for this called the tax adjusted ending wealth chart here in the comparison tab. And what this shows us is, the client's invested asset portfolio at the very end of their plan. And we can directly compare the tax allocation as well as the ending portfolio value. So this can be a great chart for this sort of, purpose, regardless of, how much we're converting and when. So first things first here, I have actually already created a scenario in advance where we're making Roth conversions up to the 22% tax bracket. So I can select that here on the left, and we can see we're converting up to that 22% ordinary income tax bracket. We can also see that as a result of those conversions, these clients are benefiting in terms of ending portfolio value, but more significantly, for their heirs in particular, 100% of their invested assets will be tax-free at that point, as compared to 13% being tax-free if we don't make any Roth conversions at all. So this is a great way to sort of demonstrate to clients some of the trade-offs there. The next thing we'll want to do here in this particular example is to create another tax strategy proposal in which we're converting to a different bracket threshold. So again, we're going to rinse and repeat that process. We're going to click Edit in the lower right. Rather than clicking Add Strategy and creating a blank slate here, you can actually also click the sort of three dots icon to the right of an existing strategy and simply choose to copy that existing set of items. So if you've already done some work in terms of dialing in some strategies and you want to spin something new off of that, that's a way to save yourself a little bit of time. So let's spin something off of this 22% scenario. We're going to change the name of this one to say, maybe we'll convert up to the 12% bracket in this other scenario here. So let's rename that and click Save. We can then choose that 12% bracket scenario on the left-hand side. The action items will be the same since we copied that 22% scenario. And now all we need to do is change the target amount for the conversions and click refresh. So firstly, we will of course see a difference here in terms of the visuals and information in the tax strategies module. So we can already see as a result of converting slightly less, we do have a different setup here in terms of tax allocation and ending assets at the end of the plan. But the next step we can then take is to implement these strategies within the context of the Monte Carlo analysis as well. So of course, even when we're planning for a client's heirs and trying to set them up for success in terms of minimizing taxes upon inheriting these clients' assets, the client's probability of success is also an important consideration as well. And we want to make sure that we're setting our heirs up for success while also maintaining a probability of success that we're comfortable with. We wouldn't want to convert too much too quickly and, potentially risk, lowering our probability of success. So it can definitely be helpful to set up this kind of comparison in the retirement analysis module as well. So for something like this, maybe we want to actually create two new plans here dedicated to these specific tax strategy scenarios. So let's go ahead and add two new plans to our case study here. We'll call this first one 22% Roth conversions. Click Save, and then we'll create a second one here, and we'll call this one 12% Roth conversions. So we have our two new plans added. Once we click OK, we'll then have the ability to select those plans on the left and right-hand side here. So let's start with our 22% conversions. This should be identical to our current plan. So, we're using the current plan as a baseline here. But if we scroll back down to the action items, we should now have the ability to choose that 22% Roth conversion scenario and implement that into this specific proposed plan. So let's click refresh here. So we can see the impact of that scenario on the left-hand side here. Let me just refresh both of my pages here to make sure that everything is synced up and up to date. Perfect. Now if we scroll back down, hopefully we'll see that 12% scenario up here, which we do. So the next step here would then be to select that other plan we created on the left-hand side. Again, this will be a blank slate to start things off. With that selected, we can scroll back down, choose the 12% scenario, and click refresh. And now that we've implemented those specific tax strategy proposals into these specific what-if scenarios, we can set these up side by side and see the direct impact of those two different tax strategy scenarios here. So we'll be able to see in our action items, everything's the same. All these variables are the same, except for the Roth conversions. On the left, we're converting to 12%. On the right, we're converting to 22%. And while the probability of success is the same in this particular instance, we do see a difference in ending assets. So that's certainly something to consider as well, in addition to the probability of success. So that can be a valuable way to set up those more direct comparisons, similar to what you might do if you're setting up a pension option comparison, or maybe you're comparing the impact of retiring at different ages, selling properties at different times, etc. We can now set up comparisons just like that when it comes to tax strategies. So that can be a valuable way to take those different options and see how they impact a client's bigger picture here in the probability section. Just to wrap things up, in addition to the probability of success, there are some other charts available, particularly in the comparisons tab here, that you may want to reference when you're setting up a side-by-side comparison like this. So this chart, it was not using the Monte Carlo analysis. This area is using a straight line linear growth projection using your return assumptions. So this allows us to do some more specific comparisons between some different elements of the plan. So, we have a comparison of a client's invested assets over time, and we can see in this case, converting to the 12% bracket does help us to maintain our investments a little bit more over the course of this plan. We can directly compare taxes, which is a great visual to use for something like Roth conversions. And in this case, we really very clearly see some of those timing trade-offs in terms of taxes. We can see when we're converting to that 22% bracket, we're really paying a lot of taxes here in the early years of the plan, and those pretty much go away, after the clients fully convert all of their tax deferred assets. Whereas, converting slightly less, we are still paying some taxes in those early years, and they do drop off a bit in the later years. But of course, we're not completely eliminating those like we are in this other scenario. So this can be a great way to show clients, some of the tax impacts that they can expect by converting more earlier on and paying less in RMDs later on. So I always like to highlight some of these comparison tab visuals just as a way to sort of hammer home some of those important talking points.